Hey everyone, and welcome back to the Above Board podcast. And today is going to be a fun and maybe controversial episode, but we are talking about the upcoming election this year. It's, as the date of this recording, it'll be about 4 months out, I believe. And we've got the world famous Michael Scott from Canterpath with us. Hey, Michael.
Hey, John. Good morning. Thanks for bringing me on for all these controversial ones. I feel like I always get lobbed these topics.
You literally only get the difficult ones. That is the prerequisite for you coming on the podcast, is to talk about all the hard stuff. But I think it'll be a good and useful conversation for our listeners. What do you think?
I think it'll be good. And like you said, we are going to talk a little bit here about the elections. And as a preface here, this is not supposed to be a political conversation, a conversation of on the issues of who's right and who's wrong and where those lines are drawn, but more of what do the economics and what do the markets look like during election years? How does that affect the psyche of investors, and how do elections affect what we do as financial professionals?
Yep. And most importantly, I think everybody wants to know this question, which is, Michael, who are you voting for on the? No, I'm just kidding. We're not doing that. To Michael's point, it's exactly it. We've had this conversation a lot this year, and then I think he and I can both think back in instances in our career, the 2020 election, 2016, where there was a lot of volatility leading up to the actual election itself. And between now and the time that between the airing of this show and when the election happens, there's sure to be volatility. And so we kind of want to speak to that, and I guess maybe ease the minds of listeners as it relates to their investment portfolio and how they're thinking about managing risk when you see, when you turn the news on and you're like, oh my gosh, the Dow's down 1,000 points today because, the outcome of the election's unknown. How are we going to navigate those feelings? And what should we be doing about that? So Michael, let's start there, because I can remember certainly that I mentioned the last 2 years. I can recall other ones, but gosh, the 2020 election resulted in so much market volatility, and yet a positive market year. So maybe, do you think we should start there a little bit about election years and volatility in and of itself?
Yeah, and I think you framed an interesting question first. Like, what should you do to de-risk a portfolio or something in an election year? And quite honestly, the answer might be nothing, because your portfolio's asset allocation, your strategic asset allocation, should be set in the beginning to withstand the ups and downs of the market, right? We shouldn't necessarily be making these wholesale changes on any year to year. Granted, things change in life, employment, marriage status, kids, family issues, whatever that is, that can change that. But an election shouldn't necessarily have an effect on your asset allocation. And we bring up 2020, right? It's the most recent election year, and it might be probably one of the most interesting ones we've had in a while. But with COVID, there was a lot of volatility that was already baked into the market. And the election was almost just a catalyst and a match that really set that fire off, right? So when I think about election years, I like to go back to 2016, because really what happens in election years, there is a buildup of volatility throughout the summer, but it often peaks at that end of October going into the November timeframe. It's when we get into the week before an election. There are exceptions to this, right? If there's an election that seems to be going one way or the other directly, a lot less volatility is built in because we know what's happening. But as we get closer and closer to a tight election, there can be a lot of volatility when new polls are put out, because that can shift the calculus for the market one way or the other. And we go back to 2016, very tight. And a lot of people were thinking that Clinton was going to win this election. And you get to election night and Trump starts winning states. And I don't know if you remember this, but the future started plummeting overnight when it looked like Trump was going to win. At the end of the day, I'm pretty sure and we can pull it up here, the markets actually had a great year in 2016, relatively speaking. So I think we go to that. John, can you pull up that slide on presidential election years?
I definitely will. So I'm pulling that up for the folks listening to this podcast. We're going to talk through it, but this is maybe a good call to action to go check us out on YouTube and follow our on our YouTube channel. We do the video portion of this podcast as well, and this is the first time we've ever done this, but we're actually screen sharing some data points. So, Michael, to your point, I've got the last, I guess, what is this, 22 elections going back to 1940, and then the relative. Is this the S&P 500?
Yeah, so
Okay.
from 1988 to 2024, every 4 years we have the S&P 500 total return index. So we're looking at price change and reinvested dividends.
Mm-hmm.
Prior to that, you're looking at the S&P 500 price return. So we're not looking at dividends,
Got
which
it.
can add up over years. So if we look at a year, well, before I say that, we look over these past 2024 elections, there are 4 negative years, right, John? There's 2008, there's 2000, 1960, and 1948. Interesting thing there, if just looking at the data, this is more of a math nerd side of this equation. If you included dividends in 1960 or 1948, that could have been a positive year or a flat year. But really, on a presidential election year, the market does very well.
Yeah.
2008, notable exception, minus 37%. We also were in the midst of the financial crisis. And then the other one that's significantly negative was 2000, minus 9.1%. And we were in the start of the dot-com bubble.
Yeah.
So
Sorry, go ahead.
I was going to say, so those are the two notable negatives in this. Otherwise, surprisingly, I think for a lot of people, it is significantly positive. I'm looking here real quick, and there's 2 returns over 25, several in the 20s. Most returns are in double digits, actually.
What I love about the chart is everyone assumes, well, we know that volatility exists. It seems ever present, especially in the last handful of years. But everyone assumes an election year is going to be especially volatile. And though that might be true within the year, it's very interesting to see this chart. I think what pops out to me is looking at going back to every election since 1940. And there's 4 years in which it was 4 election years in which it was negative, and like you said, 2 of which were very minimal, and then the other 2, 2000 and 2008, were these very monumental crises that we were experiencing that we all remember, in the recession and then the dot-com crash. Right? Was that 2000? No, that was technically 2001, wasn't it?
Yeah, well, the dot-com bubble began to burst in 2000, right? So we
Yeah.
had 2000, 2001, and 2002 were negative years in the market.
Yeah.
But 2000 was really when the wheels began to come off. When we
Right.
look at that and we look back and, post to your initial question, what are the changes you need to make to your portfolio in an election year? Or if you're thinking about making a changes because the election is very emotional, very heated, the data suggests you don't necessarily need to make a change, right? That being said, I think we have to go to the compliance side here and point out that past performance is not always indicative of future results, and this is not a guarantee whatsoever.
Leave it to our CFA to say that.
But we look back in 2012, 2016, 2020, 2024, we're positive 16 and 12. We're positive, almost positive 12 in 2016. 2020, in the midst of the COVID pandemic and the Trump Biden election, you're up 18%. So far this year, the economy is doing a lot better, and we're up close to about 16%. Now, depending on when this podcast goes off, there's
Mhm.
going to be a little bit of a change in that market return. But to answer the initial question, we don't necessarily need to make a change to asset allocation or to change our mix of stocks and bonds right now.
Yeah, and I think 2020 is a good example of, I mean, that was such an emotional year, not just because it was an election year, but because of what happened in COVID. And it always, I mean, I'm going to remember this forever and ever, amen, because I remember March of 2020 where the markets dropped by a third. And what we were really preaching with clients back at that point in time was like the emotional psychology of investing and the importance of staying invested. And it's cool to look at that chart and go, gosh, in 2020, the S&P was up 18.4% when it was all said and done. If you January 1, if you fell asleep and never looked at the market again until December 31st, you'd wake up and go, "Oh man, it's a good year." Like,
You
cool.
probably had a pretty good year sleeping through COVID.
Yeah, it was a great year. But when you lived through it, you remembered like the turmoil and just this hand wringing stress of what was happening on a day to day basis. I mean, but I like using that as an example because it's really important to stay invested and not allow this outside noise to impact our decisions. And that there's another chart that I have, not one that you prepared, Michael, but one that I have, and I'm not going to share it here. But if you go from like 1990 through 2020, if you miss the 10 best days in the S&P 500, your return would be cut almost in half. 10 days. Isn't that crazy? And that's a testament of like why it's really difficult to pick and choose what days you should be invested. Go ahead.
It's also really interesting that when you look at those days, because I'm familiar with those studies, when you look at where the best days are, often the days with the highest positive magnitude change, and getting a little technical here again, but often the best days are clustered around the worst days.
Right.
So, and that's one of the reasons why market timing is so difficult, because you have a bad day and maybe you avoid it, maybe you experience it, but you get out. Statistically speaking, a very good day is going to come quickly. And you have to know when that's going to come. And that is very, very difficult to time in and out. So, that goes back to your point about like missing the 10 best days changes your return significantly, because oftentimes you sell and then you wait to get back in till things settle down.
Yeah.
And that's very difficult to time that correctly.
Yeah, it's so true. What would you say to our listeners that, because obviously we have a lot of listeners that are clients. And so I think those folks that work with us, know us, that are in these meetings and conversations with us, this is not new for them. And they've got a financial plan. They know to stay focused on it. And they've heard us talk about emotional bias in the market. What would you say to those folks listening to us that maybe they're doing this themselves, or there's this, I will get political for a second, because we have this political bias where maybe we think if our person gets in, or whether it's Democrat or Republican, that's going to tend to skew the markets more positive. I mean, I hear that all the time. And no matter who is sitting in the Oval Office, it's either that person's fault or that person's credit. And sometimes I feel like they maybe get too much credit or too much blame, but that's a different conversation for a different day. But what would you say to the folks listening to this that are, to try to help them create some clarity around a political bias they might have as it relates to their investments specifically?
I'm trying to think of the exact best phrase to sum it up, other than don't let your like political perception become your investing reality.
Ooh, yeah.
Because
That.
when we go back and look at the data around there, the data suggests that perception that a lot of individuals have isn't the actual case. So, perfectly pulling it up now, this was a study done by JP Morgan in conjunction with the Pew Research Center. And they surveyed a bunch of people and they asked them to self-identify themselves as Republican or leaning Republican, or Democrat or lean Democrat. And then it surveyed them and it asked them to rank the economy as good or excellent. And I suppose it also asked them to rank it bad or poor or whatever the other side is, or neutral as well. And it graphed the percentage of people that gave a good or excellent answer. And it should come to no surprise that if your person is in power, if you're a Republican and you have a Republican oftentimes you identify with that and you have a more positive feeling. And correspondingly, if you're a Democrat and there's a Republican in power, you ranked things less positively. So let's look first here from 2000 to 2008, right? We have blue for Democrats, reds for Republicans. And there's a massive difference between the amount of people who self-identified as Republican and gave a passing grade to the economy as opposed to those who were Democrats.
for those listening and not watching, I mean, this would be a good reason to go check out this chart because it's a stark difference between 2000 to 2008 that we're sharing on the YouTube video because this is crazy to see.
Yeah, and to put some numbers behind it, it's something, you know, in the years of 2004 to 2007, anywhere from 40-ish to 65-ish% of Democrats gave the economy a passing grade, and it was around 10 to 22-ish% for Democrats. So there's a massive differential there. Now, when we go into the Obama years, that chart flips and
Mhm.
Democrats are now on top and Republicans are now on the bottom. And then,
Interestingly, not as wide of a variance though.
yeah, and that's partly because if we look to the 2008 2009 frame where that election was for, I believe it was McCain and Obama at that point,
Yeah.
coming out of the financial crisis, that was the only time on this chart that we really agreed for a significant period of time. And we all agreed things kind of stunk at that point. So
Mhm.
in the beginning of 2009, less than 10% of Republicans or Democrats gave the economy a passing grade. And I think we can all agree that no one would really say the economy was doing well at that point in time.
Right.
But we fast forward 8 years, and there's the Trump election, and leading into the Trump election, for those that are listening, Republicans were giving the Obama economy only about a 20% people were giving it a passing grade of good or excellent. Suddenly, almost overnight, it looks, and granted this is over a time frame of the survey, that number jumps to above 80% of Republicans surveyed under Trump gave the economy a passing grade.
Right.
And then going into COVID, we see that number drop. It rebounds a little bit into the election, but it falls off a cliff during the Biden years. And Republicans right now are only giving about a 13% passing grade, as opposed to Democrats at 44% of passing. So it's something very interesting to look at, that when your person in the White House who you identify with, you give things a much better grade than otherwise. Now, what I think is probably the most interesting thing about this is below the chart that we're looking at. It shows the Obama and the Trump years, and it shows their timeline, and it gives two numbers. It gives the S&P 500 average annual return and the real GDP growth annualized over that period.
I want to pause here because I love that you're pointing this out, and this is really important for listeners because I get this question so far this year. I've gotten it dozens of times from folks of does the market do better under a Republican-led presidency versus a Democrat-led presidency? And this is what you're about to share the answer to that question. So the folks coming into this thinking like, well, what's the probability of a better outcome in the market depending on who's in president? You're about to answer that based on historical data,
Yeah, based on
not predicting the future.
not predicting the future, but looking at the past two, Trump and Obama, the average annual return under Obama or President Obama was 16.3%. Under President Trump, it was 16.0%. So President Obama had a 0.3% better average annual return in the markets than President Trump did. Not and there's we can discuss that a lot, not a political statement whatsoever, but for return purposes, it's very close to being equal between the two.
Mm-hmm.
And we look down at GDP growth, the economy grew at 2.2% under Obama, and it grew at 1.8 under Trump. Now, or I should say President Trump. Historically speaking, and we don't have this chart here with us today, I believe the data shows that Republicans have a slightly better market, but Democrats have a slightly better economy on average. That being said, when it's divided control, meaning that Congress is one way and the president's the other, the economy goes up and the market goes up as well.
Mm-hmm.
So it's one of these situations where when we look at the data, if you allowed your political perceptions to dictate how you invested, whether you were a Democrat or Republican, you missed out on pretty significant growth over time. And even the Biden years are up 12% and close to a 3% economic growth.
Yeah.
So it's something to consider. And a lot of our clients are asking us right now, what do we think if Trump's elected or if Biden wins another term? What is that going to do to the markets? And there are some interesting things that we can discuss, such as like tax law coming up. And at the end of 2025, I believe, John, some of the Trump tax cuts are due to sunset. Are they
Mhm.
going to be extended? Is the corporate tax rate going to change? What happens to the estate tax exemptions? There's some interesting issues there that are very concrete and could have some effects. But I would almost make the argument, and I think you might agree with this, that it's more about the American economy and our American innovation and exceptionalism that's going to dictate things as opposed to the president. And my number one go-to right now for this is love him or hate him. If you look at Elon Musk and what he's done with SpaceX, he he is a private industry that has launched rockets into space and brought them back.
Mhm.
And there are only a couple countries that have been able to do this. I mean, countries. And now we have at least one company in the US that can do it regularly. And if you want to consider Jeff Bezos' company that can do it as well, we have now companies that can iterate like this. And that's kind of like the industrial innovation that will really drive the economy. And there are things that government can do to aid that. But
Mhm.
those are the things that we should really be concerned about. Are we innovating the correct way? Are we building the right industries in this country? That's really more important than is the guy Republican or Democrat in the White House.
Hey, thanks for tuning in to our show. Are you looking for shorter daily episodes of Above Board delivered straight to your Amazon Alexa? Join Canterpath 365 and get our daily brief with market updates, financial news, and mini podcast snippets like from today. Sign up now at canterpath365.com and we'll see you there. Yeah, that's a good point. And I'll caveat that concerned about it as it relates to our investment portfolio. I mean, I certainly we don't want to dilute the message or the importance of voting. Like Michael, we both know this. It's our right as citizens of this country to get out and do that. And the way I see it is we get to vote, a couple different ways. You can vote during election cycles, and you can maybe vote with your dollars and how we choose to spend our money. And so this isn't a message today that those things aren't important. This is a message that you need to stay focused on when it comes to your investments. You need to stay focused on your plan and the things that you can control. And I I'm going to use this example because I've had two different clients recently, Michael, bring this up to me. And so we were kind of going over the forecast of their financial future. So they're in their 50s. We're projecting out, here's what it's going to look like. Here's your probability of success at retirement at this age versus that age. And we're trying to plan for all these scenarios. What if we go through hyperinflation? What if we go through recession? Those types of
Mhm.
things. And in two different scenarios, the question I got was asking me about the impact of the outcome of this current election in 2024 on the probability of their retirement success. And they're both in their 50s. And so I kind of, based on the actuarial tables, we're planning for another 40 plus years of retirement for them. And so what I explained was, listen, guys, we have 10 more election cycles potentially that we need to be thinking about and worrying about. This specific election year, though it's important and you should be voting and you should be thinking about those things, how it relates to the management of your investments. My goal was to try to disassociate the two a little bit. I know that's a weird way to think of it, but it's a lot of what we're talking with folks about today. What would you say? What comes up for you as I explain that?
Yeah, two things come to mind right away, right? And one is it the election shouldn't change your strategic asset allocation. And that's your
Correct.
high level. How much do I have in stocks versus bonds versus alternatives if that's something that you're in, or your annuities or whatever you have, right? The election should not change that. The election may give opportunities to make tactical changes, right? So historically speaking, there were times when if one party won office, maybe putting a little bit more into defense contractors, you could make a little bit more money. You could outpace the index, or health insurers, or this industry versus that industry, or maybe you want to get out of healthcare a little bit. There are tactical things that can be done, but it shouldn't change the overall asset allocation, because that's set, like we said at the beginning, that is set for you to go through the highs and lows of the market.
Mm-hmm.
And realistically speaking, like when you said working with a client that asked about, the gravity of today's election for their retirement and their life 40 years in the future, if you're a long-term investor, the outcome of this election should not matter to you in your portfolio. And when I say long-term investor, and specifically speaking about these individuals, if you're in your 50s, actuarially one of you is going to be in your 90s. And
Mm-hmm.
actuarially just means that statistically, between a couple, a man and woman, someone's going to make it to their 90s. So, or man and man, woman and woman, however it is. Actually, man and man might not, because men don't live near as long. So the actuarial numbers might be a little bit different there. But we have to plan for 30 to 40 to 50 years in retirement now, depending on when you start your retirement. So, John, I think you have here, we did a study and we looked at market returns for long-term investors and how this plays out. And I know you can zoom in here, John, if you want. It's not super important to necessarily, but there are something like 600 different return periods in here. So we went back to December 30th of 1988, and
Mm-hmm.
we took the end of year index value on the S&P 500 total return index.
Mm-hmm.
And then we took the 1 year return. So the last trading day of 1989 was the 29th. And that year, the market was up with reinvested dividends close to 32%, 31.68. And then we took every single 1 year return. So what happened in 1990? What happened in 1991? All the way down to the end of 2023. And there's something like 35 returns, 35 1 year return periods. And
Mm-hmm.
then, because you take a year off to go to two, there are 34 2 year return periods. And so on till we get down to the very right side of this graph, where there is only one 35-year return period. So if you started investing in the beginning of 1989 and you held on through the entirety of 2023 and reinvested all your dividends, you're up to almost, if I do that correctly, 3,484.56% over that time period,
Mm-hmm.
right? And what's interesting to me about this chart is a couple things. Is one, is that the amount of green squares and green formatting on this chart significantly outweighs the red. And the red shows up as negative return years. And what we see is that the red return years actually gravitate around recession timeframes. So there's two big areas right there, and those are the return years from bubble and the financial crisis. But what's important to me is, if we look into, John, if you go to about the 11 to 10 year columns, if
Yeah.
you can zoom in right here or show that a little bit. If you're a long-term investor and you put money in the market, going back to 1989 till today, if you had a return period, or you held your investment for at least 10 years in one day, meaning out into the 11 years, there's not a single negative return period. Now, again, we have to combat this and say that there's, past performance is not indicative of future results, right? But when we look at this chart, what it does drive home is, if you're a long-term investor, if you're someone who's in their 50s and we're planning for you to live into your 90s, you're going to have 40 plus years of investments that are going to be working for you. If you're someone who is 80 or 85 and you have all your money in the markets, there might be a change that needs to occur, because a negative year somewhere could have an effect on you, right? But if your time horizon is more than 10 to 11 years out, you really shouldn't care about the election. because the data suggests that long-term investors are rewarded for their patience.
I find this to be such a useful chart, not because I want to go through every single data point because there's a lot,
Mhm.
but it's the stark difference between the red and the green, and realizing that if we've got a 10-year plus time horizon based on historical performance, we've got a pretty good shot at having fairly substantial market growth. And that's, I think, the message that we're trying to deliver is not, again, yes, the election is important, but not allowing the election to either A, dictate your portfolio or investment strategy to a significant degree, and or B, just be stressed and worried about how it's going to impact your retirement. As in the case with the clients I mentioned, I mean, we've got 40 plus years of planning ahead of them. And so I think we have this tendency though, and this is part of what Michael and I and Matt as well, who's not on this podcast today, this is part of what we enjoy in talking with clients about is this emotional bias. Like we have this tendency to think that what's happening now is the most important thing. And I mean, because our minds can't even filter the thoughts of what's going to happen in the next 40 years. There's so many events that will occur in that time. Our minds can't even process that. All we can really handle is what's happening in the now. Like those are the things that we're most consumed with as far as like fear, anxiety, and worry, and trying to help people look at it from a different perspective of yes, sure, it's important. Yes, you need to go vote and vote with your dollars and vote with your, in the election. But let's be mindful of not allowing this to create this hand-wringing stress of, and I mean, I've seen it firsthand. I mean, I've seen investors and folks so worried about the election that they're losing sleep at night. And I mean, again, I'll point to the COVID year because I think that's such a great example. I mean, not even the election, but just March of 2020 and the markets dropping, that created some serious anxiety for people, legitimately so, right?
Yeah.
But we have this bias of what's happening right now is the most important thing. And to the question that those clients asked me, I was realizing like they were so in this moment right now that we're not even thinking about the fact that gosh, we're going to have 10 more elections in the future if we're talking the next 40 plus years.
And that's wild to think about in itself. And I think you hit the nail on the head a couple times talking about it. Is we don't mean to downplay the ability and the privilege it is to vote in our elections. It's one of the greatest things that we have as United States citizens is to vote. But the future success of this country, economically speaking, is not hanging in the balance in November. We will be okay regardless. Granted, policies matter. There are different things that are important, but there are 500 different companies that make up the S&P 500, and each of those companies has how many variables that affect their company. And like that, those things are what's going to drive the market performance. And it's impossible to boil market performance down into one election that's going to occur. And oh, by the way, 2 years from then, we're going to reset the House of Representatives and part of the Senate, and we could change the makeup in 2 years, right? Like, think about how quickly time flies and how long it takes to even put anything in place. So, like you said, I don't think we're not trying to downplay the election by any means, but it's not something to lose sleep over or be concerned about day in or day out. Am I going to be okay financially if this candidate wins or that one?
I'd love to see a chart from you at some point, Michael, on the post-election market bounce. If that maybe that's something we'll put out later this year, as there will just naturally be more fears, no matter how much we talk about this. That's not going to stop you necessarily from worrying. We're trying to help give that perspective, but that might not stop you from worrying about your portfolio and your retirement as a result of the election. But
Being
I
told
know
don't
there's such a
worry
thing
about
as
it always
post-election.
helps the best, doesn't
What's
it?
that?
Being told don't worry about something you're worrying about is always the best thing.
Yeah, I know. That's so true. But I know there is this thing called post election bounce, and I think the markets something like on average the S&P is up over 5% in the years following an election year, which would be interesting to see those data points at some point. Maybe we'll release that. But again, all we're really trying to do today, guys, is create perspective around your investment strategy and your finances during and amidst an election year. Michael, any parting words of wisdom you want to leave our audience?
I think we're good. It's the number one thing I'd say is don't go into the election, or don't lead up into the election looking at the markets bouncing around and worry that your financial success is hanging in the balance. There are so many more variables that go into it, and like you said, when you're planning for retirement or planning in retirement, there could be 5, 10, somewhere around there, and more of elections that have to occur. And each one, I can only imagine the stress you go into if every 4 years or every 2 years, thinking your retirement is hanging in the balance.
Yeah.
We can't worry about it in that way.
Yeah, I agree, and I think that's why we're so rules based in our investment philosophy. And I think anybody, whether you work with us or not, should consider being very rules based, so that you're removing that emotional tendency out of your investment strategy. So what I mean when I say rule based, I mean maybe that's following an asset allocation, making sure you're resetting that asset allocation periodically. As an example, there's a lot of different rules somebody can follow when it comes to their finances, but that's just one idea to help with the emotional turmoil that can come with investing. So thank you all for hanging with us today on the Above Board podcast. Michael, thanks for joining us and talking about these heavy topics every time.
Thanks for having me, John.
We'll maybe do a post-election one where we can bring you on and then we can talk more. I'm going to come up with just the most difficult topics I can think of and have you come and talk about them. Is that okay?
I can't wait. Post-election, what's going to happen to the markets?
Yeah, exactly. All right. Thank you, everyone, for listening to us on the Above Board podcast. We will see you next week. And like I said, be sure to check us out on YouTube. Lots of good. Maybe we'll put a link in the show notes for that so you can check out these charts that we referenced while we were talking on this podcast. So until next week, we hope you have a great day. Take care. See ya. Bye.